students, it is time for you to understand your auditor. And today I would want us to look at the various types of opinions that are normally given to clients by their auditors. My name is Dr. Joshua Aura, and I work for Aura and Company, which is a licensed firm by ISPAC, offering tax, internal audit, external audit, and advisory services. Audit opinions, and I mean the implications on financial reporting. So first of all, I would want you to appreciate the fact that an audit opinion is a formal statement. A formal statement issued by an auditor, external auditor, regarding the accuracy and fairness of an organization's financial statements. The type of opinion reflects the auditor's assessment of whether the financial statements present a true and a fair view in accordance with the applicable financial reporting framework. Now, if, for example, Aura and Company is given a job to audit company XYZ, so of course we'll be able to get their annual reports and we review them. At the end of the day, our responsibility will be to give an audit opinion on these financial statements as to whether they reflect a true and fair view. There are four primary types of audit opinions. We have what we call an unqualified opinion. So if I give an qualified opinion, which is basically a clean opinion on XYZ's annual reports or financial statements, what basically I'm saying here is that the financial statements of XYZ are free from material misstatements and they comply with the relevant accounting standards. International accounting standards, international financial reporting standards. It suggests that the auditor has no reservations about the financial statements. Number two, we have what we call qualified opinion. Qualified opinion. All right. It is issued when the auditor identifies specific issues that are material but not pervasive to the financial statements. So, for example, auditing XYZ's financial statements. And then I realize the sales in the income statement is very good. Cost of sales is very good. Perhaps there is one specific item. Call it, for example, depreciation. Just one or two specific issues on these financial statements that are not all right. So in that case, Aura and the Company will be able to issue what we call a qualified opinion. So under qualified opinion, we are saying except for depreciation, except for the specific issues that have been able to identify that the financial statements of XYZ Limited portray a true and fair view. So if we have a few specific issues, all right, which are not right on the face of these financial statements, then I should be able to bring those issues out, issue what we call an except for qualified opinion. Except for the issues that I've identified, the financial statements of XYZ are okay. So these issues could be due to a disagreement with management over accounting treatments or limitations in the scope of the audit. The auditor specifies the nature of the qualification in the report. So the auditor must specify the nature of the qualification in his report. Then we have number three, adverse opinion. So adverse opinion in this case here now we are looking at situations where we have the misstatements being pervasive. Pervasive means what here? Quite huge. All right. Affecting various parts of these financial statements here. An error or omission, which basically affects, it touches on sales, it could be touching on receivables. You can see in this case here, this is a type of a quote unquote cancer, which has already spread. It's no longer localized, right? So adverse opinion, this opinion is given when the auditor concludes that the financial statements are materially misstated and do not present a true and fair view. Such an opinion indicates significant issues with financial statements, making them unreliable for decision-making purposes. So we go for this adverse opinion when those errors, when those omissions are what here are pervasive. They are material and pervasive. Qualified is only when those errors or those issues identified are only material. They are affecting specific accounts. All right. But when you realize that whatever issue you have at hand is now like a snake, which is basically moving around, it is affecting most of these accounts, most of those items in the balance sheet, in the statement of financial position, or in the income statement, then automatically that's an adverse opinion. That's pervasive. You're going to say that generally the financial statements are not good. Remember, underqualified, I said underqualified, we have here except for the one or two issues that I've picked, the financial statements are portraying a true and fair view. But an adverse, you're saying that the financial statements are not. They do not present a true and fair view. They do not present. So basically, an adverse opinion, we are saying that these financial statements, all of them, they are not good at all. Then we have a disclaimer of opinion. It is issued when the auditor is unable to obtain sufficient appropriate audit evidence to form an opinion on the financial statements. This situation arises when there are significant uncertainties or limitations that prevent the auditor from expressing an opinion. I just come to audit your organization. And then you tell me that, the accounts department got burnt down yesterday. Remember, as auditors, we base our opinions on evidence. So if there is no evidence at all, you've limited all my efforts to accessing any evidence that will be able to help me form an opinion, and been able to limit my operations around, then the only good thing is to come and tell the whole world that I was not able to form an opinion. So I issue what we call a disclaimer of opinion. In addition to this audit opinion, auditors may include other matters paragraphs in their reports to provide additional context or information that is relevant to understanding the financial statements. I repeat, in addition to the audit opinion paragraph we'll be having, auditors may include other matters paragraphs in their reports to provide additional context or information that is relevant to understanding the financial statements. This paragraph can address issues such as what we call EOM, emphasis of matter. So whenever we have an emphasis of matter paragraph, it highlights a significant event or transaction that is disclosed in the financial statements, but is of such importance that it is fundamental to the user's understanding. All right. So, ladies and gentlemen, for example, the directors of the company in the financial statements have said that they are facing a going concern matter. All right. But for example, they are not foreseeing themselves surviving the next 1 year. You see, it is the directors who have been able to disclose that in the financial statements. But I know most of the users of these financial statements, most of the potential investors and even existing investors, all right, most of these stakeholders will not be able to read the notes to the accounts, will not be able to read what has been disclosed by the directors, but most of these people will be able to read the auditor's report, because most of the people outside there would want to rely on the auditor's report to be able to make investment decisions. And that is why, even if the directors have been able to disclose such a matter, if I feel that this matter is important to the users of the financial statements as an Audit company, as your auditor, then I should be able to come straight away here and do an emphasis of matter paragraph where I emphasize that kind of what here a matter as per the director's notes, as per the director's disclosures. number this and this. The directors have been able to highlight the fact that the company is facing financial challenges. So basically, I'm coming here to emphasize. All right. And then we have other information. Whenever you hear about other information, in the annual reports that have been given to audit, I'm not going to just audit numbers. I must also ensure that, for example, the chairman's statement, the CEO statement, all right, they're also in line with the numbers. At times you get, for example, management trying to cheat, where managers will come and tell, in this case, in their stories, where they are required to write brief statements. They come and say that they grew, the sales grew by 10%. But when I go to the financial statement myself as an auditor, I realize that the sales, yes, they may have grown, but say by 2%. So if that is the case, then I should be able to introduce what we call other information, referring to information outside the financial statements, such as management reports that the auditor considers relevant to the user's understanding. These additional disclosures are very important. They help users of the financial statements gain a more comprehensive understanding of the entity's financial position and performance. For those of you who have never seen this Mwalimu before, my name is Dr. Joshua Aura. I work for two institutions. I work for Aura and Company, which is a licensed audit, tax, and advisory organization. And of course, we are licensed by ITBAC. Then I also work for RCM College, where I happen to be the principal. If you're willing to reach out to us, our number is 0719 525 000. Thank you so much. Be blessed.